Welcome back, friends. When I made my video in the morning, I mentioned that the Dow, S&P, Nasdaq expected to open on a very strong positive note. In fact, Nasdaq futures were almost up 180 points at that point of time. However, I mentioned that as we go further into the session, you will see some good and sharp falls, dips in the market. I did not have any knowledge of the initial jobless claims numbers, but these were my mathematics, my calculations that although Jeremy Powell, the Fed chairman, yesterday had indicated that a cut in the interest rates could be on the table of the FOMC at its September 2024 meeting. Uh, Yet, I believe that there were some two factors that could play on the markets. One was that the US economy would begin to weaken substantially and quickly now. Secondly, the rising geopolitical tensions. And third were my certain calculations about the US presidential elections, about the economic impact. And all these three could make an unholy cocktail and come to play on the markets today. At this point of time, you're seeing that the Dow Jones is down 460 points, a 1.2 percentage. S&P 500 is down 0.7 percentage, while the Nasdaq slipped almost 1%. The initial jobless claims have risen to 249,000 for the week ending July 27, which is higher than the Dow Jones forecast of 235,000. The ISM manufacturing index has come in at 46.8, less than the 50, which is the important benchmark, and it is adding to a broader picture of a slowing economic activity. This data follows the Federal Reserve keeping rates unchanged yesterday, and the chairman Jerry Powell signaling September rate hike, a rate fall very much on the cards. Yields have fallen Thursday as the investors have digested Powell's comments, with the benchmark 10-year Treasury yield reaching its lowest level since February 2 and slipping below the 4 percentage mark. In addition, we have the Bank of England cutting interest rates, look like almost in a hurry, and all this could be an impetus to other central banks across the world also to start cutting interest rates. Economic data has kept on rolling on in the direction of a downturn, if not a recession. But the stock market doesn't know whether to laugh or to cry, because while these Fed rate cuts may be coming this year and the 10-year bond yields are falling below 4%, the winds of slowdown, a quick slowdown, are also coming and are being felt hard. The Fed funds futures trading has indicated an 86% likelihood that the central bank cuts rates by 25 basis points at its September meeting. According to CME Group's FedWatch tool, the stocks did begin on a high note, however, with Meta platforms rallying nicely, about 7% on stronger than expected second quarter results and upbeat guidance. We had Shake Shack, meanwhile, jumped more than 15% after posing a revenue beat. ARM Holdings slid 14% after offering an underwhelming current quarter guidance. Moderna plunged 17% after slashing its full year sales guidance. The 10-year Treasury yield has dropped below the psychologically important 4% level as the manufacturing sector has slipped deeper into contraction, and expectations have risen for the Federal Reserve to start cutting interest rates. Yet, the economic news of a slowdown has outweighed the Federal Reserve's starting to cut its interest rates in September, and that is weighing on the stocks. This I predicted before the markets opened. Markets were opening solid, strong at that point of time, with the futures, Dow, S&P, Nasdaq strongly higher. This is the advantage you get. We tell you in advance. Do join our Prime or Prime Plus groups, which are addressed specifically for the US stock markets. We'll tell you where the markets are headed over the next few days, weeks, and months. You can join our Prime or Prime Plus groups by WhatsApping us on 98208610044. Alternatively, you can email us at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. Have a great investing day ahead. Happy investing. Take care. Bye bye.